Well, if you want one prediction for
Yeah.
2024,
Yeah.
I think it's going to be a year of resolution. I think it's going to be a year in which we come to grips with major problems politically, economically, financially, and in terms of where and how this economy is growing.
So I think we're going to have a recession. I think we're going to have a very volatile political period. And we have two major wars, one in Europe and one in the Middle East, that could easily slide into something much bigger than we expect.
Welcome back, everyone, to the Geeks, Geezers, and Googlization show, the home of Googlization Nation, where we talk with HR and business thought leaders about the crazy shift going on all around us and explore the disruptive convergence of technology, business, and people. Here are your hosts, Ira Wolf and Jason Cochran.
Well, welcome back, everyone, to a very special episode of Geeks, Geezers, and Googlization. I'm Ira Wolf. Thank you for being part of Googlization Nation.
And I'm Jason Cochran. If you think this is just another podcast, think again. We're the voice of the most important conversations on the future of work that's confronting business leaders and people today. Our goal is to bring you ways to reimagine tomorrow and explore the ever-changing convergence of business, technology, and people.
Well, we've got our favorite Wall Street team here with us today from Odeon Capital Conversations. I can't believe we're talking about an economic wrap-up for 2023 and an update for 2024 already. But joining us today will be Dick Bove, Matt Van Alstyne, and John Aidan Byrne. They're familiar names on Geeks, Geezers, and Googlization, and we'll be getting started with them shortly. But we've got to ask the question, Jason, where did 2023 go? And for those who are loyal listeners, going back 12 months ago, we were talking about the likelihood of a recession, 8% inflation, and rising interest rates. The war in Ukraine had just started. Here we are 12 months later, and we've got a Fed rate of 5.25% to 5.5%, substantially higher than it was before. But we just closed the last quarter GDP growing at 4.9%, which hardly sounds like a recession. So we got to ask the question, what's going on and what lies ahead? Stay tuned. But before I bring on our guest today, I want to share a huge recognition that Geeks, Geezers, and Googlization just received. Actually, this morning, bright and early, 12:13 a.m. this morning, when I checked my email, we were the number one leadership podcast, according to Good Pods last week. We were in the top 5 management podcasts and number 57 in the all-time top 100. So we want to thank all our listeners, all our GGG Unleashed partners, Googlization Nation, and of course, all the listeners joining us today, and all our great guests that we've had. You can listen to any of our past episodes wherever you listen to podcasts, YouTube, or watch us on Roku now. But we've got a lot to talk about today. So let's dive into today's conversation with Dick, Matt, and John. Although these gentlemen need little introduction for our listeners, so Dick Bove, he may be the longest serving bank analyst on Wall Street today. He's been doing this for over 50 years. He's the chief financial analyst at Odeon Capital Group, and you've likely seen or heard him on shows like CNBC, Bloomberg News, Fox Business, maybe CNN, or you read one of his 10,000 plus print interviews or forecasts. And then we've got Matt Van Alstyne, who's co-founder, owner, and managing partner of Odeon Capital Group, which is based in New York City. And Matt and Dick team up each week for their Odeon Capital Conversations, which is hosted by our friend John Aidan Byrne, who's an experienced and Wall Street business journalist and editor and successful podcast host and producer. The show is now ranked, the podcast is now ranked in the top 2% of all podcasts, and it's one of the top rated business podcasts on Apple. He's also host of the very popular Dig Life Deep podcast, on which I visit each episode for an update on future of work called Future Shock 2.0. So we have a lot to talk about. Let's dig in and welcome, gentlemen. We'll bring to the stage Dick and Matt and John. Welcome back, guys.
Yeah, it's great to be back.
It's a pleasure. Let's kick off with what's going on with up where we were 12 months ago. Unless I'm doing the wrong math, 4.9% GDP annual growth hardly seems like recession talk. Dick, why don't we start with you? Where are we and what's going on?
Well, I think that 4.9% number has to be disaggregated a little bit because if you do that, you find that the growth in the quarter was not particularly exciting at all. It was, in fact, very, very close to what it was in the second quarter. And the reason I say that is because there was this immense increase in inventory building that occurred during the quarter, and that had this impact on the number that would cause it to go up to that 4.9% rate. If you take a look at the Atlanta Fed numbers for the fourth quarter, they're down at 1.2% right now, which is consistent with where I think we were in the third quarter if you take out two things. One, the inventory building, and the slight benefit we got in terms of the net export-import balance. So I don't think that it was a very strong quarter. I think it was a quarter in line with what we've seen for most of this year. And I think that since we're not going to get, the two benefits that we did get in the third quarter, I think there's still a very good chance that we could slip into a recession.
Matt, what's your take?
I mean, I think I completely agree. I think Dick is right. And, the tell here is the Atlanta Fed has a tracker called GDP Now, which it's a fun way to go in and just see where they think, GDP will ultimately end up. And they came into the quarter and they're more of like a concurrent type measurement. So, they're measuring at the end of October, they're getting ready for measuring November. They change their measurements quite frequently. Near the end of October, they were saying 2.3%. I'm talking about for Q4. Right now, sitting here right now, they're at 1.2%. Clearly, something has changed in the last 4 to 6 weeks, at least as measured by the Atlanta Fed, to show that GDP is rapidly declining.
Sounds like we're still in the same situation as we were, that there's a potential recession coming, hopefully it'll be a soft landing. But the numbers certainly have been defiant all year round. The Fed has stalled rates at least for the last few times, but there's rumors. You guys would know more than us that they may be ticking up again, maybe doing another quarter. But we still have, which is my bailiwick, we still have the labor market. JOLTS rate has come down. We no longer have 3, 4, 5 job openings per person, but we still have like 1.5 job openings per available employee. We're still at 3.9% unemployment. And again, I know we've had this conversation often that we can't predict where it's going to go, but we've said last year at this time, it may at the highest be around 4.1%, and that's what they suspect it might be. Still tight labor in many different areas. What impact? I mean, what can we expect? Is Powell going to try to control the labor markets and inflation and the growth through another Fed hike?
Ira, and picking up on something that Matt noted in our most recent episode of Odeon Capital Conversations, that in the latest Bureau of Labor Statistic numbers, the 150,000 job gains, there's a huge proportion of the job gains are in part-time work. And so the conclusion was that many more Americans are working part-time jobs to make ends meet. It's a sign of stress. And also the rise in auto delinquencies and just consumer debt has soared in recent months. So that's something to watch out for.
John, that's a great point. In that report, they're talking about how many, you talked about part-time jobs, but this is even people that are taking on additional jobs. So that part-time job is on top of their full-time employment, like you were alluding to there, which is just an unhealthy sign of stress. But let's go through those numbers you just referenced, John. I know we're talking about this at the top of the show with Dick and Matt also. It seems like Americans right now are using debt to try and fight inflation. Here are those latest numbers that just came out this week. Mortgage debt is up $126 billion this year. Car loan debt is up $13 billion this year. Student loan debt is up $30 billion this year. And then credit card debt is up 48 billion, and it smashed a record for total credit card debt for households. We're now at 1.08 trillion with a T in credit card debt. How do we go about trying to fix that?
Well, I think there will be a natural function that will fix it, because in line with the numbers you just mentioned, Jason, there was an increase in the defaults being shown. And, surprisingly, the increase in mortgage defaults has grown. And I say surprisingly because housing prices are still going up, and people don't default on houses when there's a huge profit to be made in selling the house. The credit card area showed a significant increase in defaults. Autos showing some increase in defaults, but not to the degree that the other two areas are mentioning. And the overall default numbers are not as good as they would usually be because of the student loan numbers. Apparently, they did not include a realistic number for student loan defaults because we had this period in which nobody had to pay back their student debt. So I think, you have that issue that people are defaulting on their debt. But I'd like to go back to the labor number, because I personally don't understand why those numbers are even published, okay? Because if you take a look at the four numbers that the Department of Labor puts out every month, you can see a disparity which is just mind-blowing. In other words, you had 151,000 seasonally adjusted establishment increases in jobs. If you didn't seasonally adjust the establishment number, the government is saying it was over 1 million increase in jobs. If you swing over to what is the household number and taking a look at the job market, they show that the seasonally adjusted numbers were 7,000 increases in jobs, and they show that the non-seasonally adjusted number was down by a couple of 100,000. So, you have the government coming out with a series of numbers, each one of which they would argue is totally valid, one of which is showing a substantial decline in the number of jobs that were added. Another one is showing a substantial number of increases. And then going a little bit boring, a little bit further into those numbers, the government likes to do something called birth-death analysis. In other words, it likes to estimate the number of companies that were started in a month, in a given month, and the number of people that they were hiring. Well, that birth-death number is almost 3 times bigger than the total jobs number that came out under the establishment seasonally adjusted number, which is what the press usually uses. So every month I look at these numbers. I cannot believe that they have the, I'm going to call it chutzpah, to show what supposedly the job market is doing, when they can come out and tell you on one hand the jobs numbers is down close to 350,000. On the other hand, it could be up close to over 1 million. How can they do that? I don't get it.
It's a question I had, and even going back to before when we talk about, are we accurately tracking people who are bringing in an income from doing some work? So if you look at, I just read this number the other day that there's probably 30 million people that are not tracked by the government, but are working gig jobs, whether they're through, digital work, but even the Lyft and Uber drivers. I mean, we were in Texas just a few weeks ago, and every Uber driver that was full-time work. I mean, they didn't have another job, and they say, well, maybe we'll go back, but are they even being tracked? But they're bringing in an income.
That's clearly correct, but the household series, is based upon calling up people and saying, do you have a job? Right? The establishment series is based upon calling up companies saying, did you hire someone or you didn't hire someone? Now, you would think that those two numbers would come closer together, but they're not. They're diverging at a wider pace. So I prefer to take a look at the unemployment claims number, also produced by the Labor Department, because the unemployment claims number is based upon a tangible event. Someone has gone to an office in some state in the United States and made a claim, for unemployment insurance. And what those numbers are showing in the last couple of weeks is that there was a slight decline a slight increase in the number of people, not a big increase, a slight increase, but 2 weeks in a row of the people seeking unemployment insurance. So my view is that the job market is weakening, that, there are a lot of excess laborers in companies, and my feeling is that we will definitely go through 4.25% in terms of unemployment, and I think it's going to ultimately get at the 5.25% level before it stops.
I guess my I want to say counter argument, just throwing this out to you, Dick. If they're not, if you're going by, if you find the unemployment claims more reliable, if you have that many gig workers, they can't file for unemployment,
Right.
because they're independent contractors. They're not working for anybody.
Yeah, no, you're right. You're right, Ira. And the point, Ira, is that basically these numbers can't be done accurately. That's what I'm trying to demonstrate by throwing out all these wide array of numbers. These people at the Census Bureau and the Department of Labor, they work diligently. They're very honest people. They're trying to do the best job possible, but the job that they're trying to do, I think, is beyond their capability. And I think that's true of a lot of the government numbers that we get and we tend to rely on so heavily. I just think that, attempting to look at a nation of, I think, 360 million people, how many of them are working, what the GDP is, what they're buying, etc., is a mind-blowing job. I find it interesting also to disaggregate the numbers and to see where the increase in jobs are occurring. And what I find very distressing is that manufacturing jobs are not increasing; they're going down. And my belief is that you've got to have manufacturing or producing of goods to really drive the economy. What is going up is tourism-related jobs, jobs related to healthcare, which go up every month, and government jobs are going up. And I just don't think that where you're getting this increase in calculated jobs from the government, the healthcare industry, education, workers are going up, and you're not getting it from places where goods are being produced, that is not a very positive sign.
And related to that, Dick, also, there are numbers currently that are out that bankruptcies are currently up 13% this year. So we're losing, a lot of companies that are struggling. How big of a concern is that for you? And then, Matt, to you also, how big of a concern is that 13% rise in bankruptcies? Or do you view it more as this is just part of the unfortunate side of the pruning of certain types of work in the economy as it continues to evolve and hopefully get better over time?
Well, I take issue with the word pruning. I mean, this is people's livelihoods. Like, everyone who's paying the price right now for the Fed's mismanagement of their balance sheet over the last few years, it's a tragedy for them on a personal basis. Losing a business or losing your job is a terrible situation, and it makes you almost angry that this is the system we're in, where the Fed overprints. And then when to compensate for their overprinting, they pull in the reins, raise interest rates, and start selling off bonds. And it just seems so backwards. And I also wanted to point out, like, Dick and I on our podcast, we've talked a lot about how the BLS and the household surveys and these numbers, you can't trust them. And I just keep pointing back to whether you can or you can't. That's almost not. It's almost academic. The question is, are they applying consistent methods that's capturing the true, momentum of the economy? As long as they're going consistently, when you get a jobs report like this one, which is just, you basically take four numbers and all four of them are pointing to totally different situations. The household survey shows we lost 348,000 jobs. The BLS survey shows we added 150,000, but they're including 400,000 fake ones. And of the 150,000 we added, 50,000 of them are government jobs, which is really just a tax on the rest of the other jobs. So those shouldn't count. and there's another 100,000 part-time jobs. And then you go and look at, how many people report that they're working 2 full-time jobs, or a full-time job and a part-time job, or a part-time job when they prefer a full-time job. And you get about 10 million workers are in these, what are supposed to be stressful situations when the economy is not going so hot. So, as much as the numbers aren't, per se reliable to a degree of accuracy, they are telling a story of duress and stress throughout the marketplace. And one last thing on the bankruptcies, that's just a sign of interest rates rising. That is purely a sign of not being able to refi your debt or going out and acquiring new debt, because banks are being told, because of the Fed, rein in your lending, whether it's implicit or explicit. It's we don't want to lend to risky things. We prefer you buy treasuries, and we're not going to lend to companies. And so the low interest rate, easy money world that we've been used to, where every Tom, Dick, and Harry could go out and extend and pretend their loan, is gone. And so businesses that were on the cusp are failing, and I think that's indicative of the economy we're in.
I know we'll get to it later, Ira, the money supply, because Dick has done some unique research into it, but that pumped up and primed the economy, and we saw that in the banking sector, where there was surplus excess savings by consumers, and they're drawing that down. And consumers and savers, the savings rate has dropped, and that excess money in banks is disappearing, and that's going to have a ripple effect on consumption in the coming months. So I mean, the signs are pretty clear that people have called for recession for the longest time, but it seems now it's more nearer than ever before.
Yeah, that's interesting you brought that up, and I do want to lead this into the conversation that Dick has about the money market, and we'll pull up some graphs there. But there was an article, I think it was just this week, it could have been last week, I don't know, time just seems to go by, in the Wall Street Journal, and it was about that we now have this rapidly rising group of mini millionaires. So there was a 42% increase in the number of people who now have a net worth of more than $1 million. And the number also has gone up for those that have a net worth of more than $2 million. It was pretty significant. They did say that a lot of that was eaten up, that wealth that people gained was eaten up by inflation. But is that group the group that's driving the consumption? Because there obviously is a lot of money to spend, but then you have the other end of this wage, not at the wage gap, but the earnings gap, the wealth gap. You have people that are just living day to day. So there seems to be this 10 or 20% of the population, not the 1%, but the 10 or 20% of the population that has an average net worth of $1 million to $2 million to $5 million, that has money to spend. They're all in their between 45 and 65 years old, which was this fastest growing group. But then you have the rest of this population that is struggling day to day. That's a complicated question, but is it the fact that the surge that we're seeing in the economy and the consumer spending is related to this 10 to 15 to 20% of the population that has money, but we've got this 80% that's really struggling?
Are your employees feeling stuck and just showing up for a paycheck? Is your workforce working harder to get back to normal than adapting to the future? It's time to help them break their addiction to certainty and develop a growth mindset. Developed by one of the world's top-rated future of work thought leaders, AQ Plus Mindset is a powerful tool to help your employees embrace change, adapt faster, and grow on the job. Conveniently delivered to any smartphone or laptop and easy to digest 5 to 10-minute lessons. Managers can sit back and watch employee attitude shift towards growth and innovation in just 30 days. Are you ready to help your employees thrive in this ever-changing, never-normal world? Encourage them to show more grit, resilience, adaptability, and unlock their potential? The journey to a growth-filled future starts with a growth mindset. Visit aqplusmindset.com or call 373 4300.
Yeah, I want to broaden what you just said because, and I want to quote three sources. One, Bank of America recently put out some data indicating that the net worth the amount of assets being managed in the United States has jumped from 25 trillion 10 years ago to 65 trillion today. $40 trillion increase in 10 years. 200 years to get to 25 trillion, 10 years to get to 65 trillion. The chairman of Goldman Sachs, David Solomon, said that there is $70 trillion under management in the country today. And, the chairman of Morgan Stanley indicated that he's very confident that Morgan Stanley will reach the $10 trillion mark in terms of money being managed. And the question, which I've actually started working on this a week ago, and I do not have the answer, is where is this money coming from? How can we have a $40 trillion increase in 10 years and a $25 trillion increase in 200 years? What is happening which is causing this to occur? Now, in the initial, and again, I have nowhere close to answering this question, but in the initial forays into the numbers, I discovered that, we've got $140 trillion as being the wealth of U.S. households. $140 trillion. Now that includes their real estate, it includes, the other implements that they may own, but the bulk of it is financial in nature. What has happened? Is it, huge government deficits, which resulted in massive money creation? Is it, the fact that, the dollar has been rising and interest rates in the United States are higher than they are elsewhere in the world, and that's sucking money in, to the United States from elsewhere in the world? I don't know the answer, but I just cannot believe that there is that much money around, and I cannot believe that it's going to continue to grow at the pace that it's been growing.
Matt, I
Just
can
like
see
to
the wheels
quickly add to
spinning. So,
that Ira, that you mentioned that 20% the growth in the millionaire class, and some of that could be inflation, of course. But the savings rate the excess savings rate has been spent out, and it's the group in that 1 million, the high net worth consumer that has, that excess savings to spend out. But, most of it's gone. I think we're down to 500 billion in excess savings. So, but it's held by that affluent group,
right.
the amount that's left, which is sort of interesting and ties into what you and Dick were talking about.
Matt?
I was just thinking the basic formulas you learn in macroeconomics in college, which it's if you have the investment plus government spending minus taxes has to equal private savings, plus imports minus exports. And so, to see this much growth of domestic savings almost belies the export story. And I'm just trying to sit and think, where am I getting this wrong? And I don't really have a good answer. I feel like the answer has to be explained somewhat, at least, by inflation. Because when we measure inflation in the United States, we measure the price of consumer spending, whether it's on goods or services, but it's consumer spending. But what doesn't really get captured in that is the overall inflation of household wealth. And, I kind of wonder if, we've been on a tear for houses and home prices in America, that if you just look at it as one house, there's just one house in the United States, and that's our housing supply. It's gone up almost 2.5-fold since 2000. I think it's almost threefold since 2000. And so I kind of suspect that that's the answer of where these assets are coming from, is people are getting mortgages or not paying off their mortgages quickly because they have these super low interest rate mortgages that they got. Hopefully it's all of us. We got in 2020, and with your excess money, you're not paying off your debt, because why would you? And you're putting it into other investments. And I think that's why it's showing up for me to square the circle on where this money's coming from. I think it's coming from household wealth. To answer Dick's question,
I want to come back to labor a little bit, and it also may play into where the GDP was and some of the unemployment for the last quarter, but it's obviously going to change with layoffs and strikes. So, we had the layoffs from in the automotive industry. We've had a lot of layoffs, but they're still not anywhere near where, what the record was. It's certainly a employees market. Where does that fit into your updates or forecasts or projections for the future? I mean, and again, and we haven't even touched on wage growth yet.
Well, the UAW strike, struck me as being kind of interesting because, one can make a compelling case that, if management is increasing its income by 25%, if the corporation is increasing its profits by, a sizable amount, that they've got to share some of that increase with the laborers. So, the laborers get the increase, right? And what does that do? In my mind, all I think of, it's increasing the sale of Toyotas and Nissans and other, foreign cars, because basically, Americans are not willing to pay for this increase in labor in terms of the increase in cars being sold. So I think on a net basis, if you add in, we always talk about manufacturing being weak. If you add in the impact on manufacturing that this is likely to create, and you add in the impact on inflation that it's likely to create, I think that overall it's not positive for the economy. It's very negative. The ISM numbers came out last week. I think it's what Institute of Supply Management, which shows what corporations are thinking of doing in terms of ordering goods, hiring people, increasing their prices, et cetera. And, the service side of the economy, showed, a moderate increase, not as much as it had been increasing, but a moderate increase. The manufacturing side of the economy showed devastating decreases. I mean, if these numbers are anywhere correct, the manufacturing sector is already in a recession. So I think that much as people do deserve increases in their income, and much as there seems to be a significant skewing between the upper, if you will, income earners and the lower income earners, there's got to be a better way of reallocating funds throughout the economy, because I think that these strikes are not positive. They're not positive for increasing GDP, and they're not positive for holding down inflation.
Dick, is this where this concept of universal basic income could eventually kick in at some point to help mitigate the gap between the haves and the have-nots?
I think it has to, right? I mean, it just, we're seeing this, the Gini index for the United States, the last time I looked, was pretty close to the one for Haiti, and that's really devastating. That's not good at all. So I think you're right, Jason. At some point, there's got to be a reduction in the gap, which tends to grow on a regular basis.
Hey, Matt, it looked like your eyes were going to pop out of your head when you said that.
Yes.
Me and Dick agree on so many things, and the universal basic income as a concept, when it's written down on paper, sounds a lot like socialism as a concept when it's written down on paper, and it really comes down to implementation. And we agree. Obviously, the Gini coefficient, comparing us to Haiti is just, I feel like that's just kind of like titillating. It gets you excited because Haiti is clearly a poorly run country, and we're not a poorly run country. And when you're comparing the richest people in Haiti, the poorest people in Haiti, you're talking about people who live Western modern lifestyles with air conditioning and flush toilets to people in extreme, absolute dire poverty, which is not the case in the United States. The wealth and the rich and poor gap in the United States, people who generally have flush toilets, air conditioning, cell phones, cable TV, and drive cars. And the question, how many cars do you have, and how easily can you afford it, and where are you getting your money from? Is it from government handouts? So I don't feel like throwing words around like, oh, we're just as bad as Haiti, advances the argument so much. And the problem really is in America, when we're talking about a UBI, because of our tax system, you're by and large taxing the highest earners in America to subsidize the lowest earners or people who aren't working in America. And that won't really make a dent in the Gini coefficient, because the highest earners in America are a massively disparate group from the wealthiest people in America. And the wealthiest people in America, the wealth transcends generation after generation after generation. And you saw my face, that you'll see my face react to that whenever you hear a presidential debate. When Al Gore or Barack Obama was talking about, we want to tax the wealthiest 1%. Well, that's a lie. They're never actually talking about taxing the wealthiest 1%. They're talking about taxing the 1% highest wage earners, and those are different people. Because if you're in the wealthiest 1%, by and large, your income comes through dividends, through collecting on your tax-free munis. I live in the state of Colorado, and one of the richest people in our state is our governor. And for 5 or 6 years straight, while he's been governor, he submits his tax returns and he doesn't pay any taxes. How can you be the richest person in the state and not pay any taxes? All he owns is tax-free munis. He has 400 million of them, and he makes $15 or $20 million a year tax-free and doesn't pay income taxes. And then you compare that to, my guess is every single one of us on this podcast makes significantly less than $20 million per year, and we're paying probably roughly between a 40 and 50% overall tax rate, depending on your state. And so, we need a better system. And I always complain on our podcast that what we don't have in America is we don't have leaders, and we don't. Look at our president. He's given one Oval Office address, and it really was to rah-rah us getting involved in 2 other countries' wars. Not really, a unifier. Not really talking about the real problems. He's never once talked about Social Security, which is going to go bankrupt in less than 8 years. When it goes bankrupt, by law, Social Security benefits are going to be cut by 27%. Same with Medicaid and Medicare. These are actual crises facing our country, and we don't have serious leaders addressing them. There's no one in Congress talking about this. There's no one in the White House talking about this. And if you want to fix the Gini coefficient, we have to change in America our taxation system so that we can actually reduce the wealth gap. And I am the first person to be against wealth taxes, it gets suggested that maybe we need to adjust the capital gains tax or the death tax. But if your goal is to fix the Gini problem, the Gini coefficient problem, you're not going to solve it with an income tax redistribution program.
I might just add here also that the COVID spending, the largesse that was spent by the government during COVID, and obviously we had a serious emergency. We risked America facing or heading into a major depression that fueled, right, a lot of this rising income inequality, because a lot of it subsidized banks and wealthier people.
Well, ignoring subsidizing banks, the PPP didn't distinguish between businesses that desperately needed the money and businesses that certainly qualified for the money. And so the average business owner, I believe, got something like $250,000 of just tax-free cash handed to them, and the average citizen who wasn't a business owner got on average something like $2,000 or $3,000 throughout the whole PPP. So yeah, that was a complete handout to the wealthy. It probably saved a lot of jobs though, because if you didn't need the money, you still had to pledge you weren't going to do layoffs. And so if you're planning on doing layoffs, because don't let a crisis go to waste. It's easier to do layoffs when the entire country is shutting down and no one can question your decision making or your stability to stay in business. But PPP probably stopped that. So I feel very I debate that one, because if the goal was to save jobs, it seemingly worked. If the goal was to get the 1% richer, that also seemingly worked.
Yeah, I guess my bigger point was that while the poorer people in our country and in the world do need a lift up, and certainly need our compassion and so on. And the government can get involved, but governments historically have been shown to be pretty poor administrators of any capital programs. They've really created major fiascos. So, this universal income concept might sound grandiose and wonderful, but I don't know how the government could properly get involved in something like that.
I really agree with that last statement, and I agree with Matt's statements about, the fact that taxation policy is not going to resolve the issues at all. My view has always been, continues to be, that we've got to turn away from being a consumption economy to a production economy, and that what we really need is not the government to interfere with us, in terms of its taxation policies or its other policies, but to stimulate, production, and that therefore the ISM numbers that I mentioned, are frightening to me, because I thought that, we about a year ago or maybe 2 years ago made the decision that we wanted to stimulate more manufacturing in the United States, and according to these, to the labor numbers and the ISM numbers, we're not doing it. But to me, the only way you can really adjust the imbalance, in terms of the wealthy and the less wealthy, is to create income. And you create income by creating products and by selling those products. And in my view, that's what has to happen. And, I'm fully in agreement with Matt also. I can't think of a bigger, what is it, a ridiculous show in the world than the American Congress. It just blows my mind that we can have this many, I'm going to call them freaks, taking control of different aspects of the government. So I have no faith in government to solve any problems. I have a lot of faith in the fact that if we allowed capitalism to work, and the manufacturing side, it would solve a lot of problems.
To that end, Dick, will AI and automation kind of help us with that? In other words, in the future, do you anticipate we'll be less reliant on the government doing things with the interest rate, because we actually will be able to do a much better job in terms of productivity with getting goods and services and products out into the market?
Yeah, absolutely. I'm a huge believer in AI. I'm a huge believer that is the salvation of the problem that I just mentioned, which is getting the cost of producing goods in the United States down to a level where they are competitive in the world market. I mean, the United States became this huge economic power in the 19th century because basically we produced things that everybody else in the world wanted, and we sold them. And that's what we're not doing now. I was shocked, that nobody knows Aesop tales anymore. They don't. Nobody reads them. None of my grandchildren have heard the Aesop tales. But the one that sticks in my mind is the grasshopper and the ants. We're grasshoppers. We're the consumers. We're not saving and putting away for the rainy day the way the ants did in the tale. And I think that has got to stop. We've got to become the ants. We've got to become the producers, and we're just not doing it. And that's very, very discouraging.
I want to challenge you a little bit on that, Dick, because you've been saying that, and I've been listening, and I've been nodding along for the last couple of years, and I think I agreed with you. And then I've been reading all this stuff about what's gone wrong with China, and I'm starting to wonder, maybe I got this wrong. And China seems to be that they've been plowing their excess savings into more manufacturing capacity, to the point that they were building houses and building, ghost cities and building subways to nowhere, and so on and so forth. And by wasting their excess savings inefficiently, they've become, much more structurally dependent on exports than an economy should be. And it's really hard for them to pivot, as modern economies around the world are, to being a consumer economy. And, we've been a manufacturing economy since Bretton Woods, but we've been manufacturing US dollars. And that's been our greatest export, and it's created our greatest wealth. And I kind of sit and think, when you talk about we should bring manufacturing back, if Joe Biden or Trump or whoever you pick as your president decides, I'm going to focus my entire presidency on bringing manufacturing to the United States, you would run into real structural problems, because you have to make it so it's cost effective to do it. And we have high cost labor, and there's low cost labor just across the border to our south. There's low cost labor all over Southeast Asia. And so what company is going to move here if they don't have to, and without some sort of like massive subsidy that we saw in the silicon chip industry, where basically the government is paying for these plants to be built, paying for the manufacturing to be built, because they know there's no way you're going to get it built here unless we make it a sunk cost for the taxpayer. And we're elevating, silicon chips to a high level, which is a national defense issue. And we've decided as a country we're going to subsidize this industry. Absent that, and by the way, that broadly speaking makes you poorer when you have less efficient investment from the government and draws out, wipes out competition. I just wonder how you're going to achieve that, actually lowering the standard of living, because it seems that free trade has actually been the biggest benefit, the biggest momentum behind the rising standard of living in the United States over the last few decades.
I think an argument could be made that China's problem was not that it generated this huge set of surpluses from manufacturing, but the way they allocated the funds that were created. I mean, in building these cities of supposedly were supposed to get to the point that they were able to handle 1 million people, and they built, I think, some 40 of them, and nobody is living in them. I think that was a bad allocation of funds. They put the money into real estate. Why didn't they figure out a way to put the money into the hands of the workers? And the answer there is clear, because if the workers got significant increases in pay the way they did in Japan, then China would not have its manufacturing edge around the world. So, I mean, all this stuff is really complicated, but I really do. I think I'm in Jason's camp when he says AI is one of the major ways to solve the problem. We've got to come up with technological answers which allow us to create products, as I say, which are low cost and very useful and can be sold to the world. And I think it can be done. I don't think that we need the government to do it for us. I think it can be done.
And it should be noted also, Dick, that even though the numbers show manufacturing is slumping at the moment, and it's in a bad way, but there have been subsidies, and say what you will, for to help in the chip sector. You had the Inflation Reduction Act and the CHIPS Act, and so there is evidence of a lot of fresh manufacturing opening up in various regions in the country. And so maybe at some point that'll be reflected in the numbers. And I mean, and they're promising like real substantial headcount and employment.
Well, I think that you're correct. But it's kind of, when I take a look at this chip situation, the point is that basically there's been massive delays in getting these plants underway. There's been, all sorts of, local regulations and requirements which are setting back getting something done there, and therefore, the government could help there by getting rid of a lot of these issues and these problems, which unfortunately it's not doing. But I mean, again, I do think that if we put all of our, if you will, knowledge and capabilities focused on, how can we produce these products? I won't repeat what I said 6 times already. It will work, and I do think it will be done because it must be done.
So we're about 50 minutes into this. We just have a few minutes left, and we haven't talked about a few really, I won't say hot topics, but certainly table topics. One is Gaza and Ukraine. What impact? I mean, I know you guys can't forecast what's going to happen with that, but it's obviously a huge issue. What impact might it have on our, on 2024?
Well, I have done a lot of reading on Russian history, going back to when I was in college. And it strikes me that if you go back to Alexander Nevsky, Ivan the Terrible, Peter the Great, Catherine the Great, one thing that emerges in Russian history, which never changed, is their desire to empire build. They always, 1,000 years, they've been doing the same thing. And if you go up to Stalin and the Soviet Union, they did create an empire every big as the Roman Empire, and every bit as possible. When the Soviet Union was broken up, there were 23 countries created from the breakup of the Soviet Union, and Russia is still, got this, biggest country in landmass in the world. So the net effect is, I think that, this is another push on the part of another oligarch or czar or whatever you want to call him, emperor, to rebuild the Russian Empire, and I think that it has to be stopped. I mean, at least from my perspective, because I don't think there's any will to not do it. And if you read the stuff that is being written today, it would appear that an oligarchy was set up in St. Petersburg, at the time of the destruction of the Soviet Union, and that this group of people, gained control of the Russian government and gained control of the major industries in Russia, and that basically they want to expand their control. If they get Ukraine or Poland or the Baltic states, which they believe, I mean, Peter the Great conquered them, and they believe that they are truly Russian, countries. Then these oligarchs will increase their wealth. I don't know why they have to, since they're billionaires, multi-billionaires, but they will increase their wealth enormously, and the Russian Empire building, which, as I say, go back 1,000 years and find any evidence in the history of Russia which says that these guys are not empire builders. But it will continue, and I personally believe it's got to be stopped.
My little joke is I think who would have predicted that Hamas will stop the war in Ukraine? But I think that's the outcome of this. Is I think America, is looking around the world and they're like, who are our allies versus who are our conveniences? I disagree with Dick. I feel like the Ukraine war clearly has been a stalemate from a particular point in early in the war. You basically have borders that don't really shift more than a few miles, a few hundred yards every now and then, and those borders are plumb full with landmines. And this is kind of how World War II or World War I had to end, which is you're not going to really shift the land battle. You're running out of money, you're running out of men, you're running out of soldiers, and you're going to have a peace deal. But go to your main thrust of your question, which is how does this affect the markets? I don't think the markets care at all, except for, does this turn into World War III? If you get into a war with Iran and the Hormuz Strait is closed and oil prices go through the roof, then that's going to really clearly impact the markets. If there's a breakthrough on Russia's, Western Front or whatever you want to call it from the Donbass, and they, start looking like they're heading toward Kyiv and heading into Poland or Romania, then you've got World War III on your hands, and clearly the markets will react. But if this stays as a war in Ukraine and, Israel versus Hamas in Gaza Strip, it's not going to have any material impact on the global economy, in my opinion.
Yeah, let me throw this to you, Matt, because I think we had this conversation before in a prior one about real estate. So we work, crashes and burns for the second time.
Yeah.
The cost of these or the value of these properties is tanking. There's more and more companies that are cutting back on their space and looking at conversions. Is it just going to be news and it makes good headlines, or is the commercial real estate market a problem?
I suspect that there are some banks out there, and I suspect there's some private funds out there that it's going to be a problem for. But I don't suspect that it's going to be a problem, like 2008, where this is the leading cause of the economy coming to a screeching halt. I think that's going to be something else. I think that's going to be your traditional, unemployment rises because people stop spending because they're out of money, and then businesses start doing layoffs, so then the consumer has less money, and then the Fed has to cut and start doing QE. I think it's going to be a much more traditional recession. In terms of, the office buildings, like everyone, it's not like jingle mail when you're mailing in your house key because you can't afford the mortgage on your fourth house that you got with a liar loan, and that's your easiest option. These are commercial real estate buildings by and large. They have tenants who are by and large probably wanting to keep their space or paying on time. And when it comes time to renewing, you look around the city or look around your neighborhood and you're like, oh, for the same price, I can get a nicer spot. And eventually that building that gets vacant, will have a clearing price. Maybe it gets converted, maybe it gets torn down, maybe it stays empty for a while. But this is on a rolling basis. There's no moment in the time where everyone who's a commercial real estate tenant mails in their keys because they can't afford it because there's no more buyers, because these leases are unrolling. And so I feel like it's going to be a much more of a speed bump type problem. It'll be in the news. Certain banks will fail if they overextend into a particular building or a particular region. But by and large, I feel like the risk is really spread out amongst the entire financial system, and it won't be the headline news that everyone's kind of predicting.
I know we're coming up pretty close to our timeline here, but I've got a really important question for John, and we couldn't have an economic update conversation without talking about crypto. So, John, or basically some pyramid collapses. So, John, I've got a cover here if I can find it. But you had a conversation with Bernie Madoff years ago and his son.
Wow.
And so what comparisons have you seen between this and Sam Bankman-Fried?
Well, I was going to make some kind of a joke about Sam Bankman-Fried got a haircut. We had, in the financial services industry, they talk about haircuts, and apparently somebody told me he did get a haircut of some kind before he went into court. These scandals come and go. You had Madoff, you had Jordan Belfort, Michael Milken, but they're all unique and different, and yet they're tied at the hip. I think there was $8 billion in losses, or he supposedly scammed his customers for Sam. And then Bernie. The interesting thing about Bernie Madoff, I think the customers have recovered over 80% of their losses, 3.2 billion. So the question is, how much will be recovered in Sam Bankman-Friedman's case? But maybe the bigger question is, why is crypto still being traded in the marketplace? There's a market cap apparently of over 1 trillion. It's obviously tumbled from over 3 trillion. I'm puzzled, and I cannot make sense of that. So I don't know, maybe Sam had something to do with that or not to do with it, but he'll be sentenced in March, and apparently he's looking at 100 years in prison or something, and we'll see.
I wonder do you think part of it might be the fascination with Bitcoin? I know these aren't Bitcoin, but they all kind of get lumped together with the cash supply manipulation issues we were talking about earlier, a lot of the research that Dick did. Is there interest in this because there's interest in there potentially being a universal currency that does have a fixed number on the blockchain that might be able to help with some of these challenges? Dick, any response?
Well, I own cryptocurrencies. Okay, so I'm not totally unbiased, but I do think that there is a function for them. There is a large part of the world that doesn't want to operate in dollars. It wants some type of universal currency that it can work with, and I think that's one driver. I think gold is not coming back strongly in price, but I think that there is a desire to use these currencies as a hedge against inflation. I think countries have moved their currencies into the Bitcoin area. In other words, the dollar is a cryptocurrency. I don't care what what people are going to argue to say that it isn't, but simple story. I once was interviewing the CFO of Wachovia Bank, and I said, "Can you show me my money?" And he said, "What are you talking about?" I said, "Can you show me where my cash is in this bank?" He says, "Well, we don't have cash in the bank. It's on our computer system." So I said, "How do I know your computer system is any good?" And then he got so mad I had to drop the subject. But the point is, the dollar is a digital currency. I mean, it's, to assume that it's an actual physical piece of paper currency would be a mistake. So I think we're trying to evolve into what the situation is going to be with, the advance in technology, the massive increase in the numbers of dollars or other currencies that can't be used, physically. It's got to be done, digitally. And I kind of have a feeling that the cryptocurrencies are going to find a piece of the action, so to speak, there. So, Sam Bankman-Fried may have been doing a Ponzi scheme of some sort. I don't know. He clearly was handed some pretty stiff, if you will, setbacks. But the point is, I think that cryptocurrencies are going to be with us for a long time, because I think digital currencies are now in the mainstream. Dollar, euro, etc.
Yeah, Dick, I apologize. We're probably not going to get a whole lot more. We don't have a lot of time to dig into the money supply, but I do want to get everybody's take on what the kind of prediction for 2024.
Well, if you want one prediction for
Yeah.
2024,
Yeah.
I think it's going to be a year of resolution. I think it's going to be a year in which we come to grips with major problems politically, economically, financially, and in terms of where and how this economy is growing. So I think it's going to be a very exciting year, in the sense that it's going to be a year in which we are going to resolve a lot of the problems that we're dealing with right now, that we're going to set ourselves on the path of a sustainable, resolutions. And I mean, economically as well as politically and financially. And therefore, I think 2024 is a year of great promise. And I think by the end of 2024, we're going to be looking at, an entree into 2025, which is going to be very, very positive.
Can't wait to get all you guys back for next year, Matt.
I would love to have whatever Dick took before he had to join this podcast. What I see in 2024 is I see two despised presidential candidates leading their tickets and seemingly inevitable. You have both parties not liking their candidate for various reasons, and the war in Gaza has really showed a split in the Democrat Party, which is much more pro-Palestinian than I think any party has been, since Israel was founded. But the Palestinians are not, the automatic losers if you go and poll Democrats. They have a lot of people that are sympathetic, and you have a convention in Chicago where you have an unpopular president fighting an unpopular war. That happened before in 1968. And if we can get through 2024 without a recession, it'll be the first time ever that the yield curve is inverted and you haven't had a recession within 12 to 24 months. So that would be, precedent setting. And it doesn't seem like, the job market is there. So I think we're going to have a recession. I think we're going to have a very volatile political period. And we have two major wars, one in Europe and one in the Middle East, that, could easily slide into something much bigger than we expect. So I love Dick's optimism. I just don't see how you draw the map that's the likely outcome, that 2024 is this big appetizer for a gangbusters 2025.
John, it looks like you're the tiebreaker.
Yeah, well, I kind of agree with some of what Dick said and Matt said. I think it's going to be the year of the great reckoning. We would all love to see the wars end. There's nothing welcome in war except in its ending. Some famous guy said that we're going to see Sam Bankman-Fried show up in court. He might actually get a haircut this time. I think we're going to see increased polarization in America. I think the presidential election and the debates are going to be rise to the level of potential fiascos. But in the end, we'll all come together as Americans and as world citizens, and we'll come out of the worst eventually.
And on a positive note, somewhere in there. So I appreciate it. This has been incredible, guys. This was a great conversation. Again, apologize, Dick, we didn't dig into your money supply graph, but you can get much more of that on Odeon Capital Conversations. As I know they talk about that all the time. I highly urge you to go up. You can get it on Apple, Spotify, all your popular podcasts. We won't see you again until the beginning of the year, but can't wait to get you back in the beginning of the year. Continue this conversation. We'll see if we're still headed toward a recession, where the wars are, what the politics looks like, if Sam Bankman-Fried got his hair cut, all the pressing things. But have a happy holiday, a good new year, and we'll see you in the beginning of the year for our next update.
Very good. Happy holiday.
Happy holiday.
And we want to thank everybody, Googlization Nation, all the listeners. Thank you for being part of our community, for listening to Geeks, Geezers, and Googlization. Thanks to Dick, Matt, and John for being such great guests and good friends of the show. So until next time, don't let the shift hit your plans.
Thanks for listening to Geeks, Geezers, and Googlization. This show was produced and edited by Hilton Productions.